Good afternoon, everyone. Thanks for joining today's webinar on equity compensation. It's called Balancing Risk versus Reward and What You Can Do About It. By the way, if this conversation raises any questions for you or you'd like to learn more about your specific situation or anything I talk about today, you can find our contact information on our website or near the end of this presentation, and I absolutely urge you to reach out. Let's start with a quick reality check. If you or the people you work with are like most professionals that receive equity compensation at work, you might have a nagging feeling that you're not handling it optimally. Maybe you're just holding on to the company stock without a clear strategy, or maybe you're exercising options based on impulse rather than coming at it from a place of truly understanding. If that's the case, you're not alone. In fact, this is one of the most common financial blind spots that I encounter when I'm working with clients. Here's the problem. Equity compensation makes up a really significant chunk of total income for many employees and executives. Yet it's often among the least understood parts of their financial picture. This knowledge gap leads to unintentional risk taking, and it can create unnecessary stress when making decisions about a really significant portion of your wealth. Clients that find themselves in this position can experience a number of negative impacts well beyond money. This can include sometimes decision fatigue around making big choices, guilt for making money but not having a plan or feeling like they're not managing it well. Sometimes it leads to financial avoidance, which stems from feeling behind and not wanting or not having the energy to dive in and take a closer look. It can include pressure to maintain success and feeling like you have to avoid messing it up. Sometimes you can even feel shame around not knowing things that you feel like you should already know. Well, today, I'm going to try to address the above by attempting to demystify equity compensation and also give you a framework for how to make smarter decisions that align with your overall life goals. As we move through today's call, we're going to discuss all of the following in a little bit more detail. First, the psychology of equity compensation and what goes on in your mind. Understanding some of the performance differences between individual stocks, like what you receive at work, and equity indexes. The concentration risk multiplier, as I call it. The tax implications of different specific equity types. Strategic approaches to managing equity compensation. And maybe most importantly, how we can help. So let's start by talking a little bit about what might be happening in your mind when you receive equity compensation and try to make decisions about how to manage it. Most people view their equity compensation as something they should keep by default. You may say to yourself, you received it in the form of stock, and if it weren't for the stock, you wouldn't have it at all. So why would you react by treating it any other way? This, though, is just an example of status quo bias, which is a well-known cognitive bias where individuals sometimes prefer maintaining their current situation and what they already have, the status quo, and they tend to resist actions that would change that. There are several other psychological factors that are at play here as well. First, very often we have a concern about taxes. Many people we work with initially resist selling company shares because they don't want to trigger tax consequences. But the problem is, if I sell, then I'll owe taxes becomes the end of the conversation rather than the beginning of a risk assessment. This may or may not be true that you owe taxes, which we'll get to later, but often it's a barrier to action regardless. Second, there's also a natural tendency to focus on the upside. Many people love telling, or maybe they love hearing about stories about some apocryphal, administrative assistant that retired a millionaire because they held on to their Microsoft stock for 30 years. But what we don't hear about as often are the countless employees who bet their financial future on companies that underperformed or maybe failed entirely. You may know this as survivorship bias, and that's a real factor for some people. That refers to focusing on people who succeeded instead of the many who fell by the wayside. More personally to you, once you've allowed yourself to dream of what life might be like in the event of a massive windfall or a big payday, it can be really hard to let that go, even if that hope is not anchored to much beyond wishful thinking. To help address this, here's a mental reframe that I suggest to clients often. If your employer handed you a cash bonus today equal to the value of all your equity compensation, would you immediately use all of that cash bonus to go out and buy your company stock, or would you diversify it? When it's framed this way, most people actually easily recognize that they wouldn't put all of their eggs in that one basket. But when they're paid in equity instead and first, many people hold on to it 100% by default. It's the same dollar amount and the same risk, and it's the same decision, it's just in reverse. That's the status quo bias at work, sticking with whatever you happen to have instead of making a first principles decision about what you really want and what makes sense for you. It's important to keep in mind that this is not an all or nothing decision. It's about balance, risk, and your broader financial goals. And that starts by reframing equity comp as what it really is: another form of your income that you need to be thoughtful about putting to use in your life. It's also worth remembering that current employees on vesting schedules will retain plenty of upside exposure to their company stock through any future unvested grants that they haven't received yet. If the stock performs well and you remain employed there, you'd continue benefiting from that success through those future tranches. Again, this is not an all or nothing proposition, and acknowledging that is a great way for people who are experiencing indecisiveness about what they should do to get unstuck. To help better understand the risk involved in individual stocks specifically, I want to take a look at a couple of statistics. The first one is that 42% of stocks in the Russell 3000 over the period covered here dropped by at least 50% and never recovered. The other important statistic here is that when stated in terms of lifetime dollar wealth creation, the best performing 4% of listed companies explain the net gain for the entire US stock market since 1926, as other stocks collectively matched treasury bills. Taking both of those facts in tandem, I want to help contextualize what we mean when we talk about risk. In terms of talking about stocks that didn't recover, that means never. That's not a dip or the kind of volatility that you can tolerate. Instead, that's price declines that never become made up. That's real losses. For the 96% of companies that didn't meaningfully participate in equity gains for nearly a century, think about how that would affect yours or any person's ability to reach their long-term goals. This isn't about short-term pain or volatility. It's about long-term consequences of concentrated risk. And it's really what kind of bet that you're making when you allow one stock's performance to drive a significant percentage of your overall returns, not knowing if it's one of the 4% or the 96%. I've found that many employees aren't fully aware of some of those stark differences in performance and risk between individual stocks, again, like what you might receive at work, and diversified indices. So I want to dive a little bit deeper into that really sobering statistic, I think. According to the MSCI data covering January 1987 through February of 2023, 42% of stocks in the Russell 3000 dropped by at least 50% and never recovered over the entire 36-year period. Think about that for a moment. Nearly half of all significant US public companies experienced a catastrophic loss that they never came back from. Yet during the same period, the overall market delivered positive returns. This happens because individual stocks are subject to what's known as idiosyncratic risks that can be devastating. A single earnings announcement can trigger a 10, 20, maybe even a 50% drop in a stock's value in a single day. We've seen clients with concentrated positions lose half their value literally overnight. By contrast, while broad market indices can certainly experience volatility, and they do benefit from the offsetting effects of hundreds or thousands of different companies depending on the index moving in different directions. When some companies have bad earnings announcements, others have good ones. That creates a smoother overall return profile. That's not to say you should never hold any individual stocks, whether that's your company stock or otherwise, but understanding the fundamental difference is helpful for making informed decisions about how much concentration risk is appropriate for you in your situation. All equity holdings are not equal is what I want you to take away from this, and filling in one stock as a replacement or a placeholder for the stock market is not appropriate. You may find that the exact amount of concentration that's appropriate for you will not match the exact amount of RSUs your company chooses to grant you, and that only makes sense. I want to shift gears a little bit here from talking about single stocks generally, and instead we're going to discuss what specifically is going on when you hold on to your current employer stock versus holding single stocks generally, and why we want to be extra thoughtful about that. So to start, let's talk about what I'm going to refer to here as the concentration risk multiplier. And I think it's a critical factor that's really often overlooked when people are thinking about their equity compensation specifically. Here's what it is. Your employer is likely the source of what I'd consider to be most people's most valuable asset, which is actually your ability to generate ongoing income. When you hold a significant amount of company stock, you're doubling down on a single risk factor that could simultaneously affect multiple areas of your financial life. So here's an example of a scenario that would keep me up at night. Your company experiences significant challenges, let's say, and as a result, you either lose your job or you face reduced compensation. And simultaneously, for exactly the same reason, your company stock, which now makes up a large portion of your net worth potentially if you kept it from equity compensation, plummets in value. This double impact effect is exactly why concentration risk in your employer stock specifically is fundamentally different from concentration in any other single stock. With other concentrated positions, your income stream remains diversified, at least from your investment. With your employer stock, they're tied together intrinsically. Additionally, if, for example, you work at a large US tech company and it comprises, let's say, a third, like 33% of your net worth, you want to be careful about having a US large cap growth heavy portfolio that essentially doubles down on that same sector exposure. Your external investments should ideally provide diversification away from, not amplification of, your equity compensation risk. In our experience, many people either haven't considered that or they're not sure what to do to create a more appropriate balance and avoid that dovetailing risk between the two. Now, as I mentioned before, I'm not suggesting you should never hold company stock. Rather, I'm just advocating for a thoughtful approach that considers this unique risk factor when you're determining how much concentration is appropriate for you. There's one last thing I want to impress as we close this section up on understanding risk. The risk of not maximizing returns if your company happens to outperform is not symmetrical to the risk of weakening potentially your overall financial plan if the stock disappoints. Now, that might not be obvious, so let me explain what I mean by that. An easy trap many people fall into is to start this conversation by thinking about what if their stock flies above markets and how would they feel if they sold it while others maybe that they work with are able to achieve wealth levels that they could have had by taking just no action. That's a really painful thought for many people. But when you consider some of the statistics we already talked about today, it's really not the most likely outcome. And while it's true that missing out on a hypothetical future big game may feel bad, it's not really as big of an impact as allowing a large percentage of your income and your net worth to be exposed to a single stock's risk. It's possible that with this proportion of your wealth, a market equivalent return would be entirely sufficient to meet your long-term goals. Would missing out on even more feel bad? Maybe, but your goals, wants, and needs can still be met, so why would that be your central focus? Meanwhile, a 50% loss and lack of recovery, as we discussed, that could be devastating. And even just underperforming without a catastrophe over a span of 10, 20, or 30 years of working could compound into falling short of goals that proper diversification would have had a higher probability, at least, of meeting. As with most questions about finances, this one comes down to this as well. If you're not sure exactly what you're trying to accomplish or how your life would change given the various possible outcomes, you should really think twice before committing fully to any strategy. So shifting gears here for a bit again, I'm going to get a little bit more practical and specific and give you some information that's helpful in understanding what goes on under the hood with some of the most common equity comp structures that you might see at your work. As is always the case, you should measure twice and cut once when making decisions about things like this by consulting with your tax accountant before making any major decisions. But still, understanding what general rules apply to the financial tools you have in your life will be important as you start to make decisions about which paths you want to seriously investigate going down. So with that said, let's dive into the tax implications of different equity compensation types, which is where much of the complexity tends to come from. We've found in working with clients that simply just clarifying this and what's going on with their specific structures of equity compensation can relieve a lot of stress and indecision for clients that have these assets. So first, restricted stock units or RSUs. These are relatively straightforward. They're taxed as ordinary income when they vest based on the fair market value at that time. Most commonly, what you're most likely to see is that on that vesting day, the scheduled amount of stock is just going to appear in your account, with an amount typically having already been sold to pay the estimated tax liability that was calculated by your employer. Often, that feature is an election that you can choose to change, but it's the default that we've seen most often and that you might have seen yourself. Any subsequent appreciation on those RSUs or depreciation is treated as capital gain or loss when you sell, with the holding period being short-term or long-term based on whether you've held it for a year or longer or not. ESPPs or employee stock purchase plans are more nuanced. First, these are not shares granted to you by your employer. Rather, these are shares that you agree to purchase from your paycheck under special terms. When you purchase the shares through an ESPP, you don't recognize income at the time of the purchase, even if there's a discount involved. I'll discuss more on discounts on ESPP later in this presentation. When you sell the shares, the tax treatment is going to depend on whether it's what's known as a qualifying or a disqualifying disposition. To qualify for preferential tax treatment, you would need to hold the shares for at least 1 year after purchase and 2 years after the offering date. Any discount you received is typically treated as ordinary income realized at the time of the sale of those shares, while the remaining gains qualify for long-term capital gains rates if it's qualifying as opposed to disqualifying. Stock options, on the other hand, those tend to come in two main flavors, which are non-qualified NQ or incentive stock options, ISOs. With NQs, you're typically not taxed when the options vest. Your options remain just an option until you exercise it and turn it into stock. When you do make that big decision to exercise, you're generally going to be taxed on the spread between the original exercise price, which is lower, of your option, and the fair market value, and that gap is going to be ordinary income. That's not avoidable through holding periods, so if you're exercising this for a substantial gain, you should expect real significant tax consequences. When you later sell those same shares, any additional appreciation or depreciation from that starting point is treated as capital gains or losses. ISOs are, despite still being options, are actually treated much differently than those NQs. Overall, they may offer more favorable tax treatment in the sense that you aren't taxed at grant, at vest, or even at exercise. And when you are taxed, there's a chance that all of that value is taxed at typically favored long-term capital gains tax rates as opposed to ordinary income, which is a big difference. To go into more detail, if you meet the holding requirements, and here's where qualifying and disqualifying dispositions reappear in the options world. In this case, that's holding the shares for at least 1 year after exercise and 2 years after the grant. The entire gain could be treated as long-term capital gain. However, there is a catch. Exercising ISOs can trigger alternative minimum tax liability. And even though that's not a regular tax event, the complexities of AMT are outside the scope of this presentation. But for now, just know you may still owe a cash outlay to the IRS upon exercise, even though technically tax may not be owed all the way until the stock is sold. Now, I know I just threw a lot of specifics at you there, and that complexity that I just discussed often leads to what I would refer to as tax paralysis, where concerns or just a lack of knowledge about what the tax implications may be can prevent appropriate risk management. When in doubt, I like people to just remember this principle. Do not let the tax tail wag the dog. Tax considerations are important, but they should not be the primary driver of your equity compensation strategy. Taxes are a factor, but if you're avoiding selling shares because of, let's say, for example, a 7% difference between long and short-term capital gains tax rates, those shares could go on to lose 30% or more while you wait. So if that's the case, then what would you have saved by waiting? Financial strategy is not all about eliminating taxes. It's really about understanding whether the risk you're accepting is worth the potential tax you may be deferring. So now that we've had a chance to discuss and hopefully we better understand some of both the risks and the tax implications, I want to use this time now to get into some of the strategic approaches that specifically can be used to manage equity compensation. So first, what I want you to do is just remember that equity compensation is income. It's a part of your paycheck, and I want you to see it that way. It would be inappropriate not to look at this as a source of income to be saved and allocated thoughtfully, just like the rest of your income and compensation. So in terms of some of the specific forms of equity compensation for RSUs, many of our clients end up adopting a systematic diversification approach. And what that really means is just selling a portion or all of the shares as they vest, and then diversifying that into a broader portfolio that's aligned with their goals. So what this does is this immediately reduces the concentration risk that we discussed earlier, while still maintaining potentially some upside exposure to the company. And that comes in the form of any remaining shares you didn't sell or future vesting. So if that stock is sold at the exact same time that it vests, there should be no additional incremental tax impact for selling more shares, since all of the shares' value is taxed upon vesting already, and that's important to know. For ESPPs, they're a little different. We often recommend maximizing your participation, if that's called for by your cash flow, whenever there's a discount or favorable pricing structure in place. So these plans, they often offer what amounts to a guaranteed return through the discount mechanism. For example, let's say that you're contractually allowed to receive shares worth $10 for $8.50. That's a 15% discount, which is pretty common. In that case, the $1.50 discount represents an instantaneous 17.6% return, $1.50 on an $8.50 investment. If you choose to realize the gain in that time, you get that return. That said, we do typically suggest selling immediately upon or soon after purchase if that aligns with your overall concentration goals. You can accept the short-term disqualifying disposition where in cases wherever the tax treatment is going to be the same regardless of holding period. So for example, that $1.50 discount is going to be taxed at ordinary rates no matter how long you hold it. This is a case where maybe a portion of the additional gains could wind up receiving worse than your best available tax rates. But most people or many people still find it's worth it to avoid the risk of holding it for a year or longer just to get a better tax rate, if that comes with substantial additional market and single stock risk in exchange for what amounts to a small percentage change in total value received net of taxes. So for stock options, those are going to be different yet again, particularly ISOs. The strategy becomes more complex. We have often developed multi-year exercise and sale plans to manage potential AMT issues and optimize the tax treatment while taking into account expiration schedules. So this might involve exercising options systematically over time to spread out tax impacts while gradually reducing concentration risk. For many people, just understanding how your existing and future holdings might be taxed provides a lot of value for determining what to keep and what to sell. In addition to that, getting a solid grasp of your expected future vesting dates and amounts can be invaluable to helping understand your overall exposure and income expectations for the year. That affects both risk and tax and saving. In some cases, when the tax liability is high enough, simply knowing what to expect may not be enough for you. For those people with larger concentrated positions, particularly from former employers, more sophisticated strategies become available, and I'll talk about those here. For positions that are greater than $250,000, single stock equity can be hedged to provide time to liquidate it and diversify it slowly. This is known as hedged equity concentration option strategy. So it involves foregoing some of both the upside and the downside risk associated with the stock in order to allow patience in liquidating, not to be paired with the amount of ongoing single stock risk. For positions that are larger, exceeding 500,000, we can actually use what's called an exchange fund replication option strategy, effectively converting much of that single stock risk exposure into broader market exposure while managing tax implications at the same time. So out of those, I want to elaborate a little bit more on what I think is a really frequently overlooked opportunity that I mentioned above, which is those employee stock purchase plans, ESPP. Many clients approach ESPPs by asking, do I want more company stock? And the answer to that may be no, considering many of the risk factors we discussed already today. But they may not be recognizing that built-in discount and that advantageous pricing structure. So with proper planning, these can be extraordinarily attractive benefits. Even if you sell the shares immediately after purchase, and again, even if it's a disqualifying disposition, which if you remember might not be the best tax rate available, beyond the 15% discount and the implied 17.6% return I mentioned before, depending on your company, the deal may be even better than that. In some cases, the employee receives a 15% discount, not just to the current market price, but also to the grant date price. For example, often 6 months earlier, if that was lower. So that means that by the time the period ends, you could have stock that has increased in value on its own, plus a 15% discount to its earlier, even lower price. The main way to lose money in that scenario is to hold on to it. So if you're able to receive and sell the shares simultaneously, you can monetize that discount directly. So I'll take a moment here to remind the audience that nothing in this presentation should be interpreted as personalized financial advice. The purpose of me pointing out the possible scenario above is to help illustrate how understanding your equity compensation can illuminate opportunities that are available to you. Always consult with your HR, your financial advisor, and also your tax advisor before making any specific investment decisions for yourself. Within our practice, we have the infrastructure in place to look under the hood of your equity compensation, and that could be your current or historical equity compensation that you already have. We can compare a high-level overview of the tax consequences of different management strategies that you're considering, and we can also compare the potential risk of action versus inaction. So, for examples, we can help you, most importantly, develop a customized equity compensation management strategy that's going to balance the risk, the tax efficiency, and your overall financial goals. More specifically, we can work with your tax professional to determine which specific lots are going to be best to sell first and diversify earlier versus which lots may be and equity types that would make sense to hold until later. We can create multi-year plans, especially for option exercise situations and sales to help manage looming potential tax issues paired with options expiration dates. For more complex equity compensation arrangements, which these are common at earlier stage companies for higher level executives, or for example, maybe if you work at a hedge fund, we in our business resource center are experienced at dealing with reading the contracts and understanding the terms and requirements to come up with a custom strategy for your bespoke employer plan. We can help understand how and when to use 83B elections to manage tax liability and timing. And we can even work to help structure deals while working hand in hand with maybe your attorney and tax professionals. So let me share a quick case study that illustrates some of this. We recently worked with a client who'd accumulated over $3 million in his employer stock from years of equity compensation that was a mix of ISOs, RSUs, and ESPP all put together. They were concerned about taxes, and they were also emotionally attached to the company, so they had sold almost none of the stock to date. After we took a look at their financial picture overall, we determined that the concentration represented over 80% of their investable assets, creating a really significant risk to their retirement plans, but also weakening their short-term goals as well. They had a young family, they wanted to buy a house, but they were cutting expenses and trying to live paycheck to paycheck out of fear of touching that company stock. Fortunately, in this case, Some of the units of stock were identifiable that we could find that had tolerable tax consequences from the client's perspective, and we were able to work with his CPA to advise on a liquidation plan starting immediately. Also, a significant percentage of the ISOs were approaching expiration within 2 or 3 years, and because of his high taxable income, in part due to those RSUs, waiting until a single tax year to exercise at the end and sell all of that at once could unnecessarily expose him to the highest possible rates on an unnecessarily large proportion of that stock. So we developed a 3-year strategy to systematically reduce that concentration in close contact with his accountant. Within 1.5 years, his family had gotten their holdings down to just 40% of their net worth while managing tax implications through strategic lot selection, thoughtful timing, and tax loss harvesting elsewhere. Roughly 1.5 years into this plan, their company's stock experienced a significant downturn, with the stock dropping 37% after a single missed earnings report. Because we had already diversified a substantial proportion of the position, the impact on the overall financial plan was manageable and not catastrophic. The losses on that single stock holding had no meaningful impact on the rest of his diversified portfolio because it really was idiosyncratic, and his family's position remains robust today. His example was extreme, but the situation is not uncommon. As recent examples, we've helped clients who worked at employers like Ibotta, Gartner, Trade Desk, Salesforce, UiPath, Amazon, Monday, Meta, Disney, and Spotify. Some of these company stocks have grown in value and helped those clients build substantial wealth. While no one, including us, has a crystal ball as to which stocks are about to outperform versus underperform, some of these companies have had similar 20 to 30% losses or more in single days and short periods, and we've helped clients reduce that risk by advising and coaching them through routine diversification. One more quick note on a different specific case. Earlier this year, we encountered a client with $3.5 million of Apple stock, which in his case amounted to 87.5% of his net worth. After discussing the risks of overconcentration, we were able to move a significant percentage of his portfolio into that exchange fund replication strategy I discussed earlier. And on day one, he was able to shift his exposure synthetically from being 100% Apple to 70% SPY or Spider's S&P 500 and 30% Apple without exercising any taxable Apple sales. As we wrap up today's discussion, I want to leave you with a few key thoughts and things to remember. First, equity compensation is a valuable part of your overall compensation package, but it calls for thoughtful management, not just default retention and keeping it because you already have it. Second, the risk of having both your income and a significant portion of your investments tied up in the same company, that creates unique challenges and it demands attention. Third, while tax implications are always important, they should inform but not dictate your equity comp management strategy. Remember, don't let the tax tail wag the dog. Finally, this isn't about all or nothing decisions. The right approach typically involves balance, maintaining some upside exposure while protecting against catastrophic downside risk. So with that, I want to say thank you for your time today. I'd be happy to answer any questions you or perhaps your clients might have about how these concepts apply to specific situations in privately scheduled meetings, as illustrated on this slide. Any talk about specific cases is much more appropriate for a private conversation, so I encourage you to reach out. So very importantly, if you'd like to learn more about any of this, or if you want to reach out with any questions, please just use any of the contact information listed on this slide to connect with our team, and we can get you set up with the answers and the conversations that are right for you. This concludes our presentation, and please be aware of the following disclosures. Registered representative and financial advisor of Park Avenue Securities, LLC, OSJ 101 Crawfords Corner Road, Suite 2405, Holmdel, New Jersey, 07733. Securities products and advisory services offered through PAS, member FINRA, and SIPC. Financial representative of the Guardian Life Insurance Company of America, New York, New York. PAS is a wholly owned subsidiary of Guardian. Northeast Financial Network is not an affiliate or subsidiary of PAS or Guardian. Arkansas Insurance License Number 204-33630, CA Insurance License Number 4260896. This material is intended for general use. By providing this content, the Guardian Life Insurance Company of America, Park Avenue Securities LLC, affiliates and/or subsidiaries, and your financial representative are not undertaking to provide advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. The opinions expressed are those of the author, and not necessarily those of Guardian or subsidiaries. Past performance is not a guarantee of future results. Indices are unmanaged, and one cannot invest directly in an index. All investments contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation or to otherwise act in a fiduciary capacity. 8299004.1 expires 8/27. To learn more, please reach out and check out our website at www.im-financial.com and subscribe to our podcast and email newsletter for more helpful tips.